Hey, what's happening once again, options traders? Well, here's a good question for the group. Are options about direction? You hear this a lot from traders, and they'll say, well, to trade options successfully, you have to pick a direction. Do you think the stock is going up, or do you think it's going down? And unfortunately, this is the way that a lot of people teach options. It's all about picking a direction and understanding, or at least having an opinion about direction. But is that really true? Well, let's go find out. But before we do, as always, please be sure to click like, and while you're at it, click subscribe. It goes a long way into promoting the channel and is definitely very much appreciated. So let's start with direction. What do we mean by direction? Well, this is quite simply bullish or bearish. Bullish means that we think the price is rising. Bearish, we think that the price is falling. And so what traders usually do is that they will buy calls if they're bullish and buy puts if they're bearish. And they think that's just as simple as it is with options. It's just about picking a direction. But again, the question we want to figure out, are options really about direction? Sure, we can make them directional, but is that really what you should be focusing on? Is that really what they're all about? Well, let's start with shares of stock. We have our delta of positive 100 plus 100, which just means that every time the stock price rises $1, if you have 100 shares, you are going to make $100. If it falls $1, you will lose 100. So you're just on this straight line at this 45-degree angle. Well, what would happen if you also shorted 100 shares of stock? Well, this is what your risk graph would look like, just leaning out to the left into the negative direction. That just shows that if the stock price falls $1, you will now make money. And if the price rises $1, you will lose money. It's just the opposite. That's why it's got a negative sign in front of it. But if you bought 100 shares and also shorted 100 shares, what's your resulting risk graph? Well, it's going to, instead of having two risk graphs like this, you're going to just have a flat line. You've completely eliminated the directional aspects, gone completely flat, or what we might call as delta neutral. Well, what if we didn't quite short 100 shares? Let's go back to our long 100 shares and we say, okay, instead of shorting 100, what if I short 30 shares? Well, that's going to be a shallower slope. We're only losing $30 if the stock price rises $1. If the stock price falls $1, we are gaining $30. So you can see that that slope isn't quite as steep as it was when we were short 100 shares. But what would happen if you were long 100 shares and short 30? Well, now your net risk graph is going to look like this. It's going to be long 70 shares. So you're still directional. So you can see that we have with shares of stock this directional component. We can either be bullish, we can be bearish, we can eliminate it by either selling out the position, or we can reduce just how bullish or how bearish. But it always has a directional component to it. Well, what if we did something similar with options? What if we did a straddle? And so we're trying to play both directions in the market. Let's say that we buy a $100 call trading for 5, and we also buy the $100 put trading for 5. So if you buy both of these, this is the $100 straddle. And in this case, it would be worth 10, just the total of those two options. So what does a $100 straddle look like purchased for 10? See, now we can play both directions. But we have another problem. We need the stock price to move far enough to get us past this break even of 110 to the upside, or below this break even of 90 to the downside. And if the stock price stays anywhere between these 2 points, these 2 break even points, we end up with a loss. The stock price didn't move far enough in order to make up that cost. See, we don't have that with stock. And that's because with stock, we can't play both directions, but we can with options. And that's another thing that makes them so powerful, but it also starts to show why we need a certain amount of movement from that underlying stock before we can be profitable. Well, again, what if we say, can I hedge the direction with an option? Is that going to change anything? Let's say that we have an at-the-money $100 call trading for 5, and it has a delta of 50, or a half, which is roughly what an at-the-money option would have. But you go out and buy 2 of these $100 calls for a total of 10. So your total delta is now 100, just 2 times 50. So by buying 2 of these calls, you are making your total delta behave as if you have 100 shares of stock. Well, what if we want to neutralize this directional component? And so we short 100 shares. So if you are effectively long 100 shares and you turn around and short 100 shares, you would think that you are delta neutral, just like we were with shares of stock. Well, what's the resulting position? So here is the short 100 shares of stock. Now remember, you bought 2 call options. So if you shorted 100 shares and bought 1 call option, you would switch from the red to the blue. But when you buy the second call option, you actually start to negate these negative deltas. We go from flat to now delta positive, and we're right back into a straddle. We still have this problem that we have to overcome this range by having the underlying stock either rise a certain amount or fall a certain amount. So we come right back to this concept that it's more about volatility with the options. So the main thing to take from this video is that as an options trader, options trading is far more about volatility. So even if you hedge direction, options need volatility to make money. And traders must understand how to assess historic versus implied volatility in order to make better decisions. Because when it comes to options, even if you have a directional strategy, you must also be correct about volatility. So are options all about direction? Well, they can have a directional component, but no matter what your strategy is, bullish, bearish, or neutral, you must always be correct about volatility. Options are far more about volatility than they are direction. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.